Hi, good morning, everyone. Thanks for joining our Phillip Security weekly morning call. Today, we have quite a few stock counters that we'll be sharing, and also on the macro end, we have our FANGAAM monthly, banking monthly, as well as our usual SG weekly. Unfortunately, we will not be having our technical analysis segment today, as our analyst Zain is on leave for this week. So, without further ado, I'd like to hand over the time to Paul to talk about Thai Bev. Thank you.
Yeah, thanks. Thanks, Sean. So I'll start first because I have a meeting later. So for Thai Bev, as the title suggests, there's no fizz in the beer. So basically, what we're trying to say with the title is that the weakness is coming from the beer sales. So the results was generally within our expectations. What did well was the spirits business, as you can see from the left. Just to a reminder, almost 80% plus of their earnings actually comes from spirits. If you look at the table at the bottom. So although the beer is mentioned a lot, but contribution of beer is actually pretty small. So what happened for the beer is they just sell more brown spirits, because for Thai Bev, they normally have brown and also white spirits. Brown is the higher price items, and they also increase price. But as a result of that, the volumes were generally flat at 0.4. The negatives all came namely from beer. So beer volumes was down. I think the first decline in almost 6 quarters, and all of it is all about Sabeco. I think Sabeco, which is the Saigon brewery, which they acquired, I think 2018. So what happened is that in Vietnam, volumes are down generally mainly from a macro picture. Even their competitor, Heineken, also reported revenue down about 24%. So Sabeco revenue, they didn't disclose yet, but it's probably down about the high teens. So what has happened is that the macro environment in Vietnam is especially weak because of the export sector is down, and especially hurt by southern Vietnam is especially hurt. So there's a lot of job losses and so forth. And that actually dragged down consumer confidence. In terms of outlook and recommendation, so we think there will be a gradual improvement in beer volumes. So how does the gradual improvement work? So firstly, for Vietnam, the expectations is that tourism should improve, and that at the margin is going to help consumption and also help on the recovery in jobs and so forth, and the whole economic environment. Basically, this is what the management says. This is probably the only way to kind of drag back up the economic environment, because it's very weak right now in Vietnam. For Thailand, they will benefit from the election. There's usually apparently free beer given. I'm not sure. I'm not there, so I don't. But apparently, there's during the election period, there's a bit more festive mood. And also post-elections, also what is happening is post-elections, the various parties have actually promised either farm handouts, a higher minimum wage, and also various support for the general public. So as a result of that, that could kind of also spur consumption demand. But the flip side of it is that the unknown is that, as we highlighted before, the excise duty for alcohol from Thailand has been kind of dragged out for some time. So there's always that risk there's going to be increased excise duty. So for us, we maintain our profit, we maintain our target price and our recommendation. There's no change. But any improvement will be gradual in general. Next slide. So as the title suggests, so for the first quarter 23 update, if you go back to the title again, what we're trying to say is that the earnings was actually pretty good this time around, but because the drag from DARE Plus, if you recall, this year they're going to spend about, I think, 150 million plus on upfront investments to transition the business into. They already fact this, I think, a few quarters, but that spending has been delayed. So that's why the reason for the title. Next slide. The results was also generally within our expectations. It was a bit better than expected, because there was a delay in the upfront investments. So the positives is that if you look on the table on the left, I think not unique to Starhub, I think all the operators, the mobile operators in Singapore, be it M1 or Singtel, they're benefiting from roaming revenue. So roaming revenue is a pure profit business. So when it comes to roaming revenue, there's no additional cost. There's only revenue, because when someone goes overseas and turn on roaming, or someone comes in to turn on roaming, it's just pure revenue for us. There's hardly any additional cost. So that lifted the revenue by 13%. As you can see, the good thing is that both prices, which is ARPU and also subscribers is also rising. So that's, it's something that every company wants. I know you raise price and the volume so up, but the price up is also mainly because of roaming being turned on. There was a bit of Q&A part. Probably the community expected higher. I think we expected even higher because 10%. Considering how the tourist arrivals has happened, we thought they should be higher. But anyway, it's still a positive. In terms of the negative, is the broadband. So broadband was surprisingly weak. If you recall, last year they acquired MyRepublic, and MyRepublic is supposed to give them the boost in ARPU, but in the end, it hardly moved the needle. Although you can see on the left here, broadband is up 20%. But if you exclude that, revenue is only up 5%. And I think the ARPU, including MyRepublic, only increased by $1. So I wouldn't think there should be much celebration after acquiring MyRepublic. But anyway, in terms of the outlook, there's no change in their guidance, although this is running ahead of their forecast. So if you look at the table at the bottom, service EBITDA margin, so they are guiding about 20% first quarter 22. So they have not changed the guidance because the so-called DARE plus cost, which is the upfront investments, they only spend 25 million. So there's another 130 million to be spent. And this will drag down earnings. So that's why we are expecting quite weak earnings for this year. We maintain neutral, we maintain our forecast, target price, everything is unchanged. But we think second quarter, third quarter, the earnings should still be weak because they're taking on all these upfront investments. Next slide. So I'll move on to the Singapore Weekly. Singapore Weekly, in terms of the macro, there wasn't that many material news, but the big one for Singapore, I guess, was tourist arrivals. So tourist arrivals continue to surge. It was in April was 1.1 million. I think March is around 1 million. Year to date, we are hitting 4 million. So we're on track to 12 to 14 million. Of course, whenever we hear headlines of tourism, we always know Thailand is huge. Thailand about 40 million, but in terms of percentage of population, I mean, for 12 to 14 million, it's actually double our population. So tourism and arrivals is actually a big part of the economy to a certain extent. So from what the STB forecasts, tourism will give us an additional 1 percentage point of GDP, which is important. I mean, if this year is going to be a slow year, growth, GDP growth, maybe 3 or 4%, then this 1% is actually very important. So tourism is actually quite a core pillar for growth this year. In terms of exports, that continues to be weak. So what we see is that, exports here refers to Taiwan and Korean exports. There's a typo here. We'll skip that. I'll show you the chart later. So for global, we continue to see weakness in US imports. So the container imports is still down about 20%. For US, I think the CPI, I think we saw that, so I won't run through it. But in general, I think one of the things that's holding back the market is also inflation is just running within expectations and it's still stubbornly high. So when the Fed meeting in June, there's still a bit of debate whether will they actually pause or raise hikes. Now, next slide. So for our tactical view, I think so far from all the electronic results that came out, I'll show you a chart later, UMS, AEM, and so forth. In general, roughly, I think Singapore export earnings are down 30% year on year for this quarter. There's no sign of a pickup. I think even in April, Taiwan Korean exports are still declining for the 6 to 7 months. And like we showed you in April, also containers. So the export environment is still going to be very weak, especially electronics. When you go to most of these calls, those that allow me to go in, I mean, some don't even let me, some don't let us get into these meetings also. I'm not sure why, but the recovery, most of the common message here is that the recovery is supposed to be in 2024. But we are a bit more hesitant because we think electronics demand was pulled forward in the 2 COVID years. And right now, retail and corporate demand and corporate spend is starting to decline. So demand is weakening. And although most of the corporates will say they are talking about restocking in second half, but even if you restock, to what level? I mean, it's unclear what level you're going to restock. So we think electronics is going to be weak until the end of this year. What did well for results-wise is actually banks. The earnings are up 50%, which Glenn will touch on later. And also hospitality. In general, the RevPAR for hospitality is up almost 80% in the first quarter. So these are the two spots that are the strongest in terms of earnings. For us, we also like China because we think China can give some uncorrelated macro upside this year because the global growth is slowing, as you can see, exports and interest rates are still rising. I mean, be it Europe or even to US, I guess they just raised, but But whereas in China right now, it's the opposite. I mean, the growth is improving and also interest rates are coming down. So China is probably for this year has a much better macro and uncorrelated to the rest of the world, which is declining. So the events you can see, we got all kinds of events just for your info. The interesting one will be on the 19th of May. There will be Bernanke and Powell will be attending a conference. Can't remember what conference, but they'll be attending one conference. So it'll be interesting to see what commentary comes up from Powell. We'll have some events here. LHN. We also have a Malaysia Sunview Group, which is a solar company. Next slide. So you can see here on the left, the Korean and Taiwan exports are down for the 6 to 7 months. So you can see there's no respite here. It continues to be weak. Likewise, we always like to track the volume of containers coming into the US as a gauge of demand. You can see that is also continuing to slide. Next slide. This is the CPI. So the only good thing is that services, which excluding shelter, I know it's very messy chart, but anyway, these days CPI is so important, so that's why we have to like eyeball it more. So the good thing is that services is starting to decline sharper, like excluding shelter, which comes with a lag. So the disinflation trade is still in, but I think the pace of it is not going to be linear. So that's the one that's causing the market to hesitate a little bit, because you're not sure whether the Fed is going to pause now or even do the a more aggressive move to tighten it. The next slide. So this is just a snapshot of all the results that has come out. So to give you a sense of the cyclicals of where the weakness is. So electronics, you can see, venture, the PAT year on year is all down. AEM, UNS that didn't allow us to go into the meeting, but anyway. These are the ones that got hit. The semiconductor companies are hit the most, I think, like AEM and Grand Venture. Commodities also have been hit very badly because of the palm oil decline. The strength is, I mean, without stating the fact, is that without stating the obvious, is that hospitality is where you see the strength. So RevPARs continue to grow very strongly among the hospitality REITs. Hospitality trusts, they're not REITs actually. Yeah. Next slide. So we did manage to go into AEM's meeting. So just to give you a flavor, I'm not an expert in system level testing, but there's no change in their guidance of 500 million. So the earnings you can see here is down about 61.8% year on year. But they didn't change the guidance, but they said that any change will be on the second half. So even with the current guidance, you're looking at revenue dropping from 870 to 500. So it's quite a significant drop. The good thing, which I think why the market is still optimistic, is that they have like 3 new customers coming out, which already been qualified, but just waiting for mass production. So the 3 new customers are some high performance chips, memory chips actually, high performance chips. They didn't say which one. High bandwidth memory chips and some ASIC chips. The technology, so for them, they are still enjoying the move. So in general, the story for AEM, if I can get it correctly, is that because of the more advanced chips, the geometry is now going to 7 meters or less, and the way they are packaged, that means they package all types of chips into one underlying package. Is called a heterogeneous package. It's like combining many chips under one the package which is the black thing that we always see by any. So the only way to solve if you want a quick turnaround in testing is to use system level testing. So that's the thing. So their expectations are for any rebound to happen is only late 2023 or early 2024 for a rebound. Next slide. Okay, so this is my last slide before I have to rush off for a meeting. So for SingPost, we also had SingPost just to give you some sense of it. I think we all know what SingPost does. So the profit was down about 58% and they cut their dividend 70%. The outlook is still not great. So for SingPost, they got 3 main business. There's postal. I think we all know sending of letters and parcels. So there's the domestic part. So they do, of course, they send letters, they send parcels. So that is weak. So domestic mail is of course always weaker. So the structural, not many people are sending letters. But the problem now for them is that e-commerce volume is also weak. So they used to be like mail is down, but e-commerce was up domestic. Because everyone started to order so many things online. So that helped them. But this time around, the e-commerce has also been weak. International volume. So this part of the business maybe not so obvious for us. I think we've highlighted before. But international volume means they actually, if a customer in China wants to go to Europe, they actually sometimes come to Singapore first. then they will aggregate all the parcels and then send to Europe. But because the connectivity in Singapore is weak, it's under 60% right now. So so as a result of this, most of the customers in China just send direct. So that's why this business is also starting to slide a lot. Basically, they're not using Singapore as a hub to send parcels. The second business they do is logistics. So that did well because of the acquisition. But anyway, in a nutshell, the outlook is weak. And they are actually undergoing a strategic review, which basically means they need to do a strategic review of the domestic post and parcel because it's starting to lose money because of the high costs. And like we mentioned, the e-commerce parcels are not coming around to offset the low mail volume. I mean, we are totally speculating here. They didn't disclose like what will be the restructuring for the postal here. One thing they could do is maybe privatize, I don't know, like what SPH did. A second thing is maybe just do a service fee. That means the government, the authorities will just pay them a service for operating the postal business. Because right now, the current structure, they said they just cannot make money. So in terms of the outlook, it's still going to be challenging for SingPost. The only thing doing well for them is FMH, which is what they acquired in Australia, which is mainly a B2B logistics, which is it's like a portal where customers want to get trucking services and everything inside Australia. So that part is doing well, but the rest of the business is going to be challenging for them. So with that, I think that should be my last slide. Yeah, okay, thanks everyone. Yeah.
Thank you, Paul. So moving on to Block, we released its first quarter earnings results last week. So basically, Block, it's a fintech company and it operates through two segments, namely Cash App segment, which offers consumer banking services as well as investing into stocks and Bitcoin. And second segment is Square, which offers point of sale solutions like credit card readers to merchants. So overall, its first quarter results, they were within our expectations with revenue and adjusted PATMI at 25% and 23% of our full year forecasts. So its total revenue in the first quarter, it grew by 26%, and this was mainly driven by its Cash App segment. So moving on to the positive, its Cash App segment, its gross profit, it grew by about 49%. And this was because of its 15% growth in its monthly active users and also strong adoption of its features like a debit card as well as instant deposit facility. So moving on to the second positive, its Block, it's focusing on expense controls. So in the first quarter, its operating expenses, they grew by about 13% as compared to a 45% surge in its fourth quarter of 2022 and 70% in its first quarter of 2022. So this significant drop, it's mainly because of measured hiring. Like in FY22 last year, it's a number of employees, they grew by about 46%. However, in FY23, it's expected to grow by about 10%. And also it's looking forward to careful sales and marketing spend. So moving on to the negative for Block, the Square segment, it's witnessing a slowdown in its gross payment volume. It did grow by about 17% as it's moving up market. However, there's a slowdown. In the first quarter of 2022, the payments volume on the Square segment, it was about like 33% growth. And it's expected to witness challenges mainly because of weak e-commerce trends and as pullback in consumer discretionary spending, mainly the food and beverage industry. So next slide, please. Moving on to its outlook for the second quarter, Block, it expects its gross profit to grow by 24% to $1.8 billion. And it mentioned that Cash App business, it's witnessing promising trends for the quarter to date. And for April month, company projects that the Cash App's gross profit should grow by about 35% as compared to Square segment's gross profit growth of about 14% year on year. And lastly, for the full year 2023, company raised its outlook for adjusted EBITDA from $1.3 billion to $1.36 billion. And this was mainly because of cost-cutting initiatives and high operating leverage. So in terms of its valuation, we have upgraded the stock to buy from accumulate as there was a recent drop in its stock price. However, we have maintained our target price of $91, mainly because our estimates are unchanged. And so to conclude overall for Block, we believe that in the long term, it's well positioned, mainly because of its diversified consumer banking product portfolio. And it mainly targets the underbanked population who don't have access to the banking services from the major banks, and also from the resurgence of in-person activities and shift to digital payments. It should benefit Block. Next slide, please. So moving on to PayPal, we released its first quarter results report last week with the title that cost savings, it's boosting its earnings growth. So overall, the results were within expectations, with revenue growing by about 9%. And this was mainly because of a 12% surge in its total payments volume on its platform. So moving on to the positive for PayPal, it's witnessing improvement in customer engagement from its existing customers. Like the company reported that the number of payment transactions per user in the first quarter of 2023, it was 53 times, and as compared to 47 times in the first quarter of 2022. So this is important mainly because the company does not need to have additional spending on advertising to attract users. So and also PayPal, it's doing driving the engagement from its existing customers through product innovations and strategic partnerships like it has with Amazon and Apple. It's a Venmo, which is a digital wallet payment service. So it has been added as a payment option on Amazon e-commerce website. So the more number of users and more acceptance for Venmo, it could boost its payments volume on its platform. And secondly, PayPal, it's also focusing on improving its profitability. So like its operating expenses, they fell by about 10% in the first quarter. And so this has led to the operating margin growth from 21% to 23%. And this is PayPal, it's doing this through job cuts and real estate consolidation. For FY23, it expects to reduce its cuts by about 1.9 billion for this year, and this includes the layoffs of about 7% of its workforce that it had reported in February. So moving on to the negative, PayPal, it reported its active accounts fell sequentially. So the active accounts for PayPal, it grew by about 1% year on year to 433 million. However, sequentially, it dropped by about 2 million. And the sequential drop, this is the first time drop that it had witnessed in last 5 years or so. And we believe that this is mainly because of higher churn from the lower usage accounts, as well as management's focus on shifting its focus rather than acquiring new customers. It's now focusing on engagement through its existing customers. And in the previous quarter, in the fourth quarter of 2022, PayPal, it did mention that for the full year 2023, it expects its number of users to be flat and does not expect it to grow. So next slide, please. Moving on to its outlook for the second quarter, it expects its revenue growth to grow by about 6.75% to $7 billion, and with a foreign exchange headwind of 1%. And in terms of its bottom line, it expects its adjusted earnings to grow by about 25% to $1.16 at the midpoint. So in terms of its full year outlook, it did not mention any expected guidance for its revenue and payments volume. However, it expects challenges to remain with weak e-commerce trends and lower discretionary spending. Also, the company, it reduced its operating margin expansion guidance. So previously, it had expected that operating margin would expand by 125 basis points. However, now it expects that to grow by just about 100 basis points. That's 1%. So this drop, company cited that it's mainly because of business mix shift. as it's witnessing strength from its lower margin Braintree segment. So additionally, lastly, it raised its earnings per share outlook from $4.95 from $4.87, and this is mainly because of incremental cost saving initiatives. In terms of its valuation, we maintain a buy recommendation with a target price of $103, mainly because we didn't change our revenue estimates. However, we slightly reduced our EBITDA by 1%, and to reflect the business mix shift towards Braintree, as it would result into additional transaction-related costs for PayPal. So overall, as the e-commerce trend should improve, we believe that PayPal should be benefit from the rising digital payments, shift to digital payments, and also through its two-sided network effects, as it serves both customers as well as merchants. And also the strategic benefits should, like through Amazon, it should help PayPal to increase its payments volumes. So that's all for PayPal. I would now like to pass on to John for Alphabet.
Thanks, Ambrish, and good morning, everyone. So I'll start with Alphabet's first quarter results. Just a disclaimer, this report is a little bit old, it's about 2.5 weeks old, so it's a little bit dated. Based on Alphabet's first quarter results, they're roughly in line with expectations. So, revenue is in line, as well as earnings. But that being said, revenue is still rather muted. Growth was only about 3% or 6% in constant currency. Earnings actually declined about 8% year-on-year compared to the first quarter of last year. Moving on to the positives, moving on to the positives, even though revenue was kind of muted, it did see some slight reacceleration. So there was about 1% year-on-year growth in the fourth quarter of last year, increased slightly to 2.6% this quarter. The key main highlights on the call were AI. There was a lot of talk about AI and how Alphabet was actually leveraging on AI for a lot of its products, especially in its digital advertising business. So it's improving a lot of efficiencies and increasing ROI for a lot of advertisers. The second was cloud, that became profitable for the first time last quarter. And we think that this is quite important because cloud is actually Alphabet's fastest growing segment. So it grew about 28% year-on-year in the first quarter, although this was down slightly from 32% in the fourth quarter of last year. So what we think is that as cloud continues to grow, at a relatively high rate, and now it's going to be, as it's become profitable, it's going to be contributing incremental positive margins for the company moving forward, which is something that Alphabet needs, especially as revenue growth has slowed quite significantly. So you've got slowing on the top line, but some margin expansion on the bottom line, along with a reduce in expenses overall. In terms of the main negative, management was still relatively cautious for 2023. They do expect digital ad revenue to remain relatively muted, mainly due to the uncertainty in the macroeconomic environment globally. We maintain a buy on Alphabet with an unchanged DCF target price of $131 with a WACC of 7.3% and a growth rate of 3.5%. Moving on to my next slide, that'll be on Meta. So Meta announced their first quarter earnings a couple of weeks ago as well. In terms of results, both top line and bottom line beat marginally. So I guess you could say they were relatively in line with our expectations. Like Alphabet, revenue growth was quite muted at about 2.6%, whereas earnings actually declined about almost 24% year-on-year. The key highlight, as similar to Alphabet, was AI continues to drive a lot of improvements in its advertising technology. So AI recommendations actually drove about 24% increase in time spent on Instagram, and it actually helped Reels monetization to improve more than 40% on Facebook and more than 30% on Instagram. The real needle mover for Meta was actually their guidance. So they actually announced relatively optimistic guidance for the second quarter of this year, indicating that a 7% year-on-year growth at the midpoint and about 11% year-on-year growth at the high end. So you're seeing quite a bit of re-acceleration in revenue growth, from 3% to 7 to 11% for the next quarter. And one of the main reasons for this is an acceleration in revenue trends, improved monetization, as well as FX being less of a headwind moving forward. In terms of the main negative profit, even though it met expectations, it actually still declined 24%, mainly due to expense growth outpacing revenue growth at 10% versus 3% year on year. However, the decline was actually significantly better from prior quarters. You can see the third and fourth quarter of last year, earnings actually declined 52% and 55% respectively. Next slide, please. So like I mentioned earlier, the revenue guidance for Meta in the second quarter was pretty good. At the same time, they also reduced their full year 2023 total expenses guide by about 5%. So now it no longer sees any year-on-year growth to total expenses, which is roughly in line with its whole theme for the year about cutting costs and being a little bit more efficient. So it's also another thing that investors were quite happy to see. That Meta wasn't really going to be spending that much more money compared to last year, and they kind of have it under control. With that, we actually increased our 2023 revenue by 3%, and our PATMI and EBITDA by about 11% to reflect significant improvements in cost savings. However, we do remain neutral, mainly due to recent stock price performance, lingering macro uncertainty, and continued ad headwinds in the financials and tech verticals, which are one of Meta's largest verticals in terms of revenue contribution. So with that, I'll move on to my next presentation, which will be on the FANGAAM monthly for April. In terms of performance, the FANGAAM was up 4.3%, beating the S&P's gain of 1.5% and the Nasdaq's gain of 0.5%. Meta was the top gainer, up 12% on very strong second quarter 2023 revenue guidance. While Netflix was the main laggard, down 4.7% after a relatively soft revenue guidance. We do expect to see near-term weakness to continue, especially in demand for tech consumer goods, digital advertising, and cloud. Next slide, please. So this is just a brief overview of the results for the FANGAAM companies for the quarter ending March 2023. Overall, revenue growth was about 4%, so nothing really to shout about. In terms of adjusted PATMI, growth was actually negative by about 3.4%. But when you take a look at something that guidance for the next quarter, and most companies only give revenue guidance for next quarter, they guided to about 4.4% year-on-year growth, which is roughly in line with what they just had in the first quarter. So these growth companies are not actually forecasting exponential revenue growth, at least in the immediate term, which is something that of a negative that we are seeing right now. Next slide, please. I won't go through Meta and Alphabet since I just did it, but I'll talk a little bit about Netflix. In terms of Netflix, we have an accumulate rating with a target price of $388. Streaming, as in the overall streaming market, share of US TV time was actually eroded a little bit by March Madness, which is a very popular college basketball tournament. And this is only shown on cable TV, so you can see streaming was down a little bit month on month, whereas cable TV actually jumped quite significantly by almost 1% due to this. Amongst the streamers, Netflix remains second behind YouTube. In terms of their first quarter results for Netflix, results were also within expectations. The revenue growth was pretty stable, about 4%. There was a 5% year-on-year increase in memberships, in line with company guidance. So what this means is that prices actually declined slightly, and the big reason for this is because a lot of the membership additions actually came from lower monetization regions like APAC, compared to more developed regions like Europe and North America. Operating income was also slightly above guidance, mainly due to higher ad revenue. But the main thing that really hit its stock price was the company actually issued very soft second quarter 2023 revenue guidance, and actually represented a slight deceleration in top line growth. There were several reasons for this, and the main reason was, or rather, The first reason was that they actually shifted their implementation of their paid sharing program into the second quarter. So you're really only going to be able to see the benefits in the third quarter and moving forward. At the same time, like I mentioned earlier, as most of their paid membership additions actually came from lower monetization regions compared to their more developed countries, you would expect some of the revenue growth to slow down even as membership growth continues. So that's it for these companies. I'll hand it back to Max for Apple and Amazon. Thank you.
Yeah, thanks, John. I'll start off with Apple. So the first major news for Apple is that it won the appeals case for the Epic Games lawsuit. In summary, the federal appeal courts, the ruling is the same as the last ruling that was announced in 2021, whereby the court rejected all of Epic's claim, but they only accepted one of its allegations. So the appeals court declared that Apple does not have a monopolistic control over mobile gaming transaction, but it did upheld that the Apple had violated California's unfair competition law by not allowing developers to use third-party payment methods outside of the App Store. So yeah, I think that this is a huge relief for Apple, because if, let's say, the appeals court agrees with Epic, it means that it will be forced to allow for third-party application marketplace to enter into the iOS ecosystem, which means that the services segment will take a hit. And then the second news is that Apple announced its second quarter earnings, which we have published our reports on as well. And this is just a quick recap. So Apple's revenue did by 2.5%, but this was better than the company guidance of 5% decline. This better than expected performance was because of the better than expected iPhone sales, which actually grew by 2% year-on-year. As for the other products, Mac and iPad sales were down by double digits, which was in line with the guidance, because both products faced challenging comparison as well as the challenging macro conditions as well. As for services, it still continued its upward growth trajectory, and it was up by 6% during the last quarter. In terms of the outlook, Apple is still expecting revenue contraction for the third quarter, and it expects the revenue to drop by 2 to 3% year-on-year, similar to that of the second quarter actually. So because of this guidance, we expect Apple's FY23 revenue to contract relative to FY23 revenue to contract relative to FY22, and this is because we think that the consumers will likely defer their iPhone purchases until the expected iPhone 15 release this September. So, but we think that this will create pent-up demand, and therefore we can expect a positive revenue growth to return in FY24. So for Amazon, then moving on to Amazon, there's not much news for Amazon. So the major one for April is that they announced their first quarter earnings, which we also have published our reports on as well. And this is just as a quick summary, revenue grew by 9% year-on-year to $127.4 billion, and this beat the company guidance of $126 billion. The international segment posted a positive growth of 1%, although it is marginal, but it is still a positive because it is the first positive growth for the segment since the fourth quarter of 2021. And the growth came because of the inflation in Europe starts to ease. For the AWS, it grew by 16%, which was in line with the company guidance, despite the fact that it still continues to see cloud spending optimization efforts by the customers. During the first quarter, Amazon also improved in terms of profitability, especially for its retail businesses. So the North America posted operating income of around $900 million for the quarter, and this is its first positive operating margins since the fourth quarter of 2021. Whereas its international segment has also decreased its negative margins, which means that they lost more money, they lost less money compared to the fourth quarter of 2022. So in terms of the outlook, AWS is still expected to decelerate its growth to about 11% for the second quarter. And this is because the sales growth for the month of April is about 5% less than that of the first quarter. So overall, the Amazon's earnings were within our expectations, and we think that AWS slowing growth is a short-term in nature, and we think that the growth will reaccelerate in FY24. And this is because Amazon is landing new customers, and the fact that its existing customers are extending their expiring contracts. So we think that so we believe that both the new and existing customers are going to increase their computing demand as the macroeconomic environment improves. So yeah, that's for Apple and Amazon. Now I'll hand over my time back to Ambrish to talk about Microsoft.
Thank you, Max. So moving on to Microsoft, there was one major news that UK regulator, it has blocked its Microsoft's proposed 69 billion acquisition Blizzard deal, and the regulator mainly cited that it would impact the competition as well as innovation in the cloud gaming market. So the regulator believes that Microsoft it owns about 60 to 70% of the overall cloud gaming market, and Microsoft it has competitive advantages like its Windows operating system as well as gaming consoles, Xbox, and it's also a leader in the cloud infrastructure, Azure. So, however, Microsoft it said that it would appeal the UK's decision, and it remains committed to close the deal. So, we do believe that the deal might go through mainly because Microsoft it's not planning to make the content exclusive for Microsoft users. However, it should offer remedies like a 10-year deal it had with Nintendo for the Call of Duty game. So we believe that the deal should go through. And moving on to the second news that its third quarter results, they were within expectations with its 9 months revenue and PATMI at 75% and 73% of our full year forecasts. So in the third quarter, its total revenue, Microsoft's total revenue, it grew by about 7%, and excluding foreign exchange headwinds in constant currency terms, it grew by about 10% year on year. And the revenue growth, it was mainly driven by its cloud business. So like Azure, it grew by about 31% year on year. And however, for the fourth quarter, company expects a deceleration of that growth rate to about 26 to 27% on a year-on-year basis. So overall, the cloud, it should grow, it should drive Microsoft's revenue growth in the near term. However, it faces challenges from the foreign exchange headwind as well as a weak demand for personal computer sales. So next slide, please. So overall, for FANGAAM, we have a neutral recommendation, and mainly because two reasons, like its price to sales ratio, it's creeping up towards its more than one standard deviation from its long-term average. And also the FANGAAM companies, they should expect a near-term weakness in digital advertising as well as a weak demand for tech consumer goods and deteriorating weak demand for its cloud businesses. So that's all for FANGAAM. I would now like to pass on to Glenn for OCBC results.
Thanks, Ambrish. So for OCBC, they released their first quarter earnings last week, together with the other banks the week before. So for OCBC, their first quarter earnings of 1.88 billion were slightly above our estimates at 28% of our FY23 forecast. And this came from higher net interest income and a reversal of the fee income decline, which was offset by lower insurance income. So I'll just jump straight to the positives. The first positive being that the fee income year-on-year decline has moderated and is actually up 14% quarter-on-quarter. So the year-on-year decline of 14% has moderated from the previous quarter's decline of 24%, and it has dipped mainly due to a drop in wealth management fees. However, it saw its first quarter-on-quarter increase in 6 quarters, and it grew 14% Q-on-Q, mainly driven by higher wealth management fees. Notably, their wealth management income was 1.1 billion, and this is 33% higher quarter-on-quarter and contributed to 33% of the group's total income. For the net interest income, the second positive, it also continued to grow and it surged 56% year-on-year, and this is led by net interest margin improvement of 75 basis points year-on-year to 2.3%. This despite the loans growth remaining flat year-on-year. The NIM expansion was mainly due to loan yields rising faster than the increase in funding costs on the back of the rapid rise in interest rates during the year. However, notably, both the net interest income and net interest margins declined quarter on quarter. This is the first decline seen in 6 quarters, mainly due to a rise in asset use being offset by higher funding costs, as well as a lower loans to deposits ratio, as the increase in deposits outpaced that of the loans. Nonetheless, they have actually increased their NIM guidance for FY23 and it's up to 2.2% from 2.1% in the previous quarter when they guided. The third positive is that their trading income is up 12% year on year, and it grew also 69% quarter on quarter. The year-on-year growth was largely driven by higher non-customer flow income, while their quarter on quarter growth was driven by both higher customer and non-customer flow income, as well as higher net realized gains from the sale of investment securities. For the negatives, the first negative would be that their allowances is up 151% year on year. Their total allowances fell quarter on quarter, but they were up year on year to 110 million. And for the quarter, they had GPs of general provisions of 54 million and specific provisions of 56 million. The year-on-year increase was mainly due to the higher allowances which were set aside for non-impaired assets. Nonetheless, their total NPAs were down both year-on-year and quarter-on-quarter to 3.33 billion, and their NPL ratio also improved to 1.1%. Their credit cost increased by 6 basis points year-on-year, but improved 23 basis points quarter-on-quarter to 12 basis points. The second negative is that their CASA or current account savings accounts ratio continued to fall, and it fell 15.6 percentage points year-on-year to 47.1%. This is mainly due to the high interest rate environment and a move towards the fixed deposits. Nonetheless, their total customer deposits increased by 5% year-on-year, and this was underpinned by the strong growth in the fixed deposits. For the outlook, their loans growth was flat in the first quarter, and this is actually falling below the bank's guidance for FY23. They have lowered their guidance from mid-single digit to low to mid-single digit, and they still do expect a slower pace of economic growth, hence the lowering of their guidance. But they still see further lending opportunities in their wholesale segment as well as sustainable financing. For the fee income, they are still positive on the broader outlook, and they expect that the reopening of China will support the China-Southeast Asia trade and investment flows. And we could expect a double-digit fee income growth for FY23. Lastly, for their commercial real estate, just a quick note on this, as it's quite a big topic nowadays. So for their customer real estate loans, it's mostly to network customers in the key markets with proven track record and financial strength, and it's largely to support the economic expansion and population growth. They mentioned that their overall LTVs are low at around 50%, and most of them are secured. For the real estate, overall, it makes up 30% of their total loan book, with more than 80% to network customers, which are mostly in Asia. And 10% of the loan book comprises developed markets, excluding Singapore. The management has also mentioned that they have done multiple stress tests, and they continue to do stress tests on the commercial real estate loans in the developed markets and are comfortable with their current exposure. So as such, we maintain a buy with an unchanged target price of $14.96, and we maintain our FY23 earnings as we increase the net interest income estimates due to the higher NIMs, which are offset by lower other non-interest income and higher allowance estimates. The catalysts for OCBC include continued interest income growth and fee income recovery, and OCBC is also our preferred pick amongst the 3 banks due to attractive valuations, a dividend yield of 6.5%, buffered by well-capitalized 15.9% CET1, and fee income recovery from China's reopening. Okay, now we're moving on to the banking monthly. Yes, okay. We'll do a quick overview of the 3 banks' results. I think I just went through OCBC, so I won't go into much depth, but I just want to point out the few highlights and what makes the results stand out. So the first highlight would, of course, obviously be the NIM, the net interest margin, as well as the net interest income. So you can see that across the board, all 3 banks showed very strong growth, continued growth, year-on-year growth at least, for both NIM and net interest income. However, you can see that the higher funding costs as such to creep in, and quarter on quarter, there was actually a dip for all 3 banks. So we should continue to expect that this gradual decline, at least quarter on quarter, will continue into the rest of the year, but the NIMs have sort of stabilized, and the guidance also has been lowered from 2.1 to 2.25% to 2.05 to 2.2%. So we should still continue to see NIMs at these elevated levels above 2% for full year 23. Loans growth has also been guidance has also been lowered across the board from mid-single digit to low to mid-single digit. The second point I'd like to highlight would be their fee income. So the fee income decline has also moderated across the board to around 7% for the banks, and it also rose 19% quarter-on-quarter, mainly due to a recovery in wealth management fees, while the credit card fees continue to sustain its momentum. We should continue to see this fee income recovery in the rest of the remaining 3 quarters of the year, and we might even see a year-on-year increase quite soon. And I think the rest of the year will sort of confirm our expectations. So for the rest, the provisions were also higher, but their credit cost is still quite low and it's contained. And we should expect the credit cost credit cost guidance will come in or below what the banks are guiding for. The CET1 ratio is also high at 14 to 15.9%, which is above their optimal operating range of 12.5 to 13.5%. Okay, so now moving on to the interest rates. Yes, we have included HIBOR. We replaced HIBOR with SIBOR, and I think because HIBOR has taken some, I guess, importance lately due to the effect that it has on the Singapore banks. So for the SORA, which is the Singapore interest rate, there is continued to rise and it's up 25 basis points month-on-month to 3.6%. And this is the highest recorded month-on-month increase since December 2022. So we still see this rise in the SORA despite a sort of a small dip in the start of the year. As for the HIBOR, it's a different story altogether. It actually dipped in April, and this is reversing the increase that it had in the previous month in March. So it's down 21 basis points month-on-month to 3.59%. And the HIBOR is actually down 170 basis points this year. So now moving on to the loans growth. Yeah, for loans growth, it's a similar story, at least for the past few months. We see it continue to decline, and it fell by 3.98% year-on-year in March. And I think across all segments, it declined. However, there's one sort of a bright spot, which is the housing loans, which continue to grow this month, and it grew 2.14% year-on-year for March. As for the current account and savings accounts proportion, it continued to dip and is now at 18.9% compared to 19.2% in February. However, the total deposits and balances grew by 5.99%, mainly due to a shift in the fixed deposits from the current account savings accounts. As for Hong Kong loans growth, it also continued to decline and it fell 3.3% year-on-year, but it showed slight improvement and it rose 0.23% month-on-month in March. Now moving on to SGX statistics. For SGX statistics, the preliminary SDAV for April fell 24% year-on-year to 969 million, as the market sentiments still remain subdued. However, the VIX also was down to 17.8 in April. This is down from 21.6 in the previous month, as the volatility sort of fell off from the turmoil that was experienced in March. The DDAV fell 11% year-on-year to 1.04 million in March. However, it's up 3% month-on-month from 1.01 million in February. For the top 5 equity index futures turnover, it saw a dip of 27% year-on-year in April to 11.36 million contracts. This is mainly due to lower tradings of its Nifty 50 index futures and the FTSE Taiwan's index futures. Now moving on to my next slide. We maintain overweight on the banking sector, and we continue to remain positive on the banks. The bank dividend yields are attractive, with upside surprises due to excess capital ratios and a push towards higher ROEs. The stable economic conditions, as well as rising interest rates, remain tailwinds for the banking sector, and the fee income recovery is also another big push for the earnings for the banks. To note that SGX is also another beneficiary of higher interest rates, and they will see that in their treasury income section. Okay, that's all I have for the banking sector. I'll now hand it over to Mel. Thank you.
Thank you, Glenn. So AREIT released the third quarter FY23 operational updates. Well, no financials were provided for this quarter. Some key operating metrics are in line with our forecast. So tenant sales has increased by 355.5% year-on-year at portfolio level due to acquisition of GEM. Despite the slow return of Chinese tourists, tenant sales was still at 120% of pre-pandemic level, since 80 to 90% of the sales are contributed by local demands. Portfolio occupancy remains strong at 99.8%, as only 1.4% of the lease expires in FY23. We expect the occupancy rate to remain stable. So at the retail side, it generated a positive rental reversion of 3.3%, which increased 1.3% quarter-on-quarter, while office rental escalation remained unchanged at 4%, with higher sales driving occupancy costs below average by 3 to 5% at portfolio level. There is still upside for rental reversion. As for the negatives, the cost of debt has increased to 2.51%, which increased 0.16% quarter-on-quarter and 1.53% year-on-year. After refinancing the 285 million euro loan in FY24, we expect the overall cost of debt to increase to around 3% and further deteriorate the adjusted interest cover ratio to 2.1 times. The gearing ratio is at 39.3%, which increased 0.1% quarter-on-quarter. As 61% of the borrowing is hedged for the next 18 months, there will be no financing risks till FY25. We expect the gearing to remain at the current level. With regard to the outlook, in order to maintain the gearing, we believe inorganic growth is unlikely unless L REIT is willing to take equity fundraising. However, there are still catalysts generated by the organic growth, such as the additional 10,200 GFA at Suyan and Somerset. Upon full deployment, this could lift the NPI margin by 2 to 3%. We also expect rental reversion from the retail side to remain positive. L REIT is currently trading at FY23 yield of 6.8%. We expect a positive carry of 1 to 2% in Milan and 2 to 3% in Singapore, despite rising cost of debt to 3%. As such, our DDM back target price remain unchanged at $0.91, with FY23 to FY24 DPU of 4.63 to 4.78 cents. Next slide, please. Next, we have a Phillip on the ground for Paragon REIT. It's a retail REIT with 2.66 billion market cap, and its assets are mainly in Singapore and Australia, and is currently trading at 5.8% yield, dividend yield. They released the first quarter FY23 result. Revenue was 72 million, which increased by 0.6% year-on-year. Its portfolio occupancy is 97.7%, which down for 0.7% quarter-on-quarter, and the WALE is 5.3 years by net lettable area. They also fixed 84% of the borrowing with average cost of 3.71%, and as only 7% of the debt is due in FY23, the cost of debt this year is expected to remain around 4%. Next, their tenant sales and footfall increased by 12% and 37% year-on-year respectively. We are optimistic about the rental reversion in Paragon this year, as currently there's only one tenant still under rental free period. Next slide, please. We also conducted a Phillip on the ground for Manulife US REIT. It's a US office REIT with 254 million market cap and currently trading at dividend yield of 33.69%. So Moss reported a decrease in portfolio occupancy on quarterly basis, reaching 86.1%, which is a 1.9% decline year-on-year. It was primarily due to Charter's decision to renew its lease and downsizing its space by 69,000 square feet at Phipps. At the end of the first quarter, the physical occupancy rate across Moss building is average slightly over 30%, and the portfolio WALE stood at 5 years. Moss gearing increased to 49.5%, with the cost of debt rose to 3.98%, while the interest cover ratio decreased to 2.9 times. Additionally, Moss previously announced that Mary intend to subscribe for more than 9.8% of the new shares as part of the recapitalization plan. This aims to reduce Moss gearing, provide sustainability and growth, and also grant access for Mary's US asset pipeline. As for the outlook, leasing activity in Moss submarket continues to be weak with limited volumes. while the lease terms remain stable, concession package remain elevated. They have been repositioning themselves to be modernized. As a result, there has been higher level of leasing inquiries for P3 since announcement, and the modernization is remaining on track. We expect this continue to benefit most. With that, I'll hand over the time to Darren to talk about Prime.
Yeah, thanks, Mel. Yeah. So for Prime, their first quarter results were below our expectations of at 21%. So that was mainly because there's a distribution income side. So that's mainly because they pay their management fee 100% in cash for this quarter. Yeah, so other than that, the gross revenue was down 1.7% because of a lower occupancy. And the MPI was down due to higher property expenses as the employees returned to office. And as a result, the distribution income was down 28.8%. But then if you strip out the change in the management fee, the distributable income was still down 22.5%. So for the positives, they managed to, they're in talks to extend their debt maturities for their 4-year term loan and the RCF, which accounts for about 34% of their total loans. This is under their main credit facility, and it should be done by next month. And this will extend their debt maturity to July 2024 for this particular 4-year term loan and RCF facility. And the fee to extend is just 10 basis points. So this is a good sign because now the US commercial market is facing so much credit tightening. Yeah, and then if they are able to do this debt extension, yeah, it's a good thing for them. Yeah, so for the negative side, the portfolio occupancy dipped to 88.6%, dipped 0.5 percentage points from fourth quarter, mainly due to the slowdown in leasing volumes. So the leasing volumes for the quarter was at 64.4 K square feet. Is down 62% year-on-year and 55% quarter-on-quarter. However, in April, already about 38.8 K of square foot were leased. So we are seeing a bit of pickup in leasing volumes in April. However, in the first quarter 23, the leases were signed at -2.6 rental reversion. That is because 2 of the tenants that were resigned, they resigned it at very low tenant incentives. So as net off, if you're just looking at net effective rents, which account for all the tenant incentives, the leases actually came in at a high positive net effective rent. And then if you don't count these 2 leases that were signed, that the overall rental reversion for the quarter would be 3.2% positive. Yeah, another negative for them was that the gearing increased 1.6 percentage points quarter-on-quarter to 43.7%. But this is mainly due to the drawdown of additional debt to pay off the distributions for the first quarter. And their percentage of debt is also percent of debts which is on fixed or hedged also declined 3 percentage points to 78 to 79%. And the good thing for them after this extension of the loan is that they had no refinancing obligations until this extension of the loan ends, which is July 2024. And then they will have to refinance this about 439 million worth of loans, which is about 50% of their loans. And their interest costs also increased 30 basis points, mainly because of the unhedged portion of their loans. So it increased to 2.7%, whereas interest coverage ratio is still within the limit of the 2.5%. So still okay for now. So for the outlook for Prime, Sodexo, which is their second largest tenant, is expected to vacate 165K a square feet because right now they lease about 191,000 square foot, but then about 25,000 of it is subleased. So when they leave, this remaining 25,000 will likely remain in the building. So this will bring their occupancy at this One Washingtonian Center down to probably about 31%. Yeah, so this is definitely a negative. But the thing is, this Sodexo is they committed about 50,000 in another building. So it looks like they're downsizing by quite a big percentage from 191 to about 50,000. So there is a slight possibility that they might retain some space, but that is yeah, it's all we do not know yet for now. And then in place rents are now 6.8% below asking rents still. So going forward, there's still a positive potential for slight single digit or low single digit positive rental reversions, even though the market is quite weak. in the US, as you all know. So with that, we maintain our buy call on our menu on Prime US REIT, but we lower our target price by 35% from 70 cents to 46 cents. It is still a buy call because our buy call usually is upwards of 20% return. So right now the price is trading at 21 cents, is at distress levels. So 46 cents is still like about 120% return for that. So based on this, we lower our FY23 DPU forecast by 18%, accounting for the management fees paid fully in cash and lower occupancy and higher costs. And then right now, as I mentioned, Prime is trading at really distressed levels at 0.3 times price to NAV, but we think at these levels at 21 cents, yeah, most of the negatives we believe is really priced in already. And then even if, let's say, going forward, their dividends, they drop, or their DPU drop by 20%. Right now, their forward dividend, forward 23 and 24 dividend yield is at 23 and 25%. And let's say if that dividends do drop by maybe 20%, we are still looking at high teens level of dividend yield at this point. So yeah, that's all I have for Prime. Yeah, next slide, please. Yeah, so for CapitaLand investment, yeah, their trading revenue was 21% of our full year estimates. So it's a little bit slightly under our estimates because of seasonality and all, but it's still under. That's mainly because their fee from fund management, the events driven fee from fund management is down 68.8%, or rather 33 million. Yeah, this is because of a lot in property transactions. And then so I'll just hit right into the positives. So the lodging management side of CLI saw fee related income grow by 38% to 76 million. This due to higher room rates as well as improved occupancy. And the portfolio RevPAR also grew 42% year on year to $81. And this is really higher than pre-COVID levels by 3%. And then in the first quarter, they also hit their target of 160K lodging units, which is really, yeah, really hit it already. So now their new goal is to hit 500 million in revenue from fee revenue from this lodging management to 500 million in 5 years time. So this is like doubling their current they're about 260, if I remember correctly. Yeah. So for the negatives, the first quarter revenue growth is only at 5.6%, while in our forecast we estimated 14%. So it's below our estimates. And this was, as I mentioned, is due to lower event-driven fees from fund management. It's down 33 million, or rather 68.8% year on year. However, the good thing is that their recurring fee remains stable for the private funds, and their listed funds, the recurring fee grew by 4.9% to 64 million. And as a result of these two, net, the result is a fee-related earnings in total from fund management. It fell 22.7% to 102 million. Another negative is that the cash flow from operations also fell 24.6% to 101 million. And then as a result of this, the net debt to equity ratio rose from 48% to 53%. And the interest coverage ratio is at 4.5%. The cost of debt also rose by 50 basis points throughout the quarter, from 3.1% to 3.6%. And right now, 62% of that debt is on fixed rate. Yeah, this slide, please. Yeah, so for the outlook, CLI's, their investment in lodging management business, it should continue to recover from the further reopening of China and the easing of travel. And they're targeting at least 3 billion of divestments in FY23, but so far they've only announced 35 million. So this is lagging their target. So they have to announce more divestments to hit their 3 billion target for the rest of the 9 months for the year. And then their FUM target is 100 million. Right now they are at 89 million. It only grew 205% year on year, or 1.1% quarter on quarter. Last quarter was at 88 billion. And this was impacted due to a rise in interest costs that affected the fundraising and cross-border fund flow. However, we expect this fee income to revenue to increase on the back of higher event-driven fees in the second half of this year. And right now, there's 7 billion of funds that could be deployed, and they are still maintaining their 100 billion funds under management by next year. And with that, we maintain our accumulate call on CLI with a target price of $1.12. This is unchanged. $4.12 is unchanged target price. So this represents an upside of 17.1% and a forward PE of 17 times. So right now ESR is also trading around 17 times. So this is kind of in line with the market. And the pickup in travel and in China's continued reopening will be immediate catalyst for CLI. Yeah, so that's all for me. I'll now hand over to Peggy to talk about SIA Engineering. Thanks.
Thank you, Darren. Okay, SIA Engineering, we have Phillip on the ground. We attended the analyst briefing after the results last week. The results show a revenue growth of 40.6% as they continue to track the recovery in flights out from Singapore and the other 6 other airports where they also have line maintenance services. But net profit actually was slightly down 1.8% because from July 23, they no longer enjoy job support scheme, and last year in FY22 they had a big tax write back at their associates. So second half of FY23 was very more representative of a normalized situation without a job support, and still they made an operating loss of 15.5 million. This is largely because the business that they do, which is MRO service provider, 75% of the costs are fixed costs, and staff cost is 52% of the total expenditure. So they really need the volume to come back up and the flights to return quickly. Okay. They also announced a resumption of dividend payment of 5.5 cents, equivalent to 2.4% yield. And at the end of the year, they ended up with a net cash of 631 million, which is 56.2 Singapore cents per share. Okay. On the outlook, if you look at the chart below, the flights that they handled at Changi is still about 20% short of the lower than a pre-pandemic level, and so is the revenue for them. But when we asked the management on whether the return of the Chinese flights will bring this back up to the pre-pandemic level, they were more hesitant to think that they will come back. They think the resumption of the 20% of flights will be choppy. Many reasons, because it's a geopolitical tensions very prominent right now, which actually affected flight paths for some airlines. So the way the aircraft move around the world now is on a different could change, because like for instance, some of the airspace in Ukraine and Russia, some countries mandated that the aircraft must not fly over those. So there's a longer journey, and the landing points might also differ. Okay, and then some of the airlines after the COVID had already had much weaker balance sheet. You look at some of the Chinese airlines, there's a good gauge from there. So resumption of flights means that they have to put back their capacity, which will also incur cost in terms of mothballing the planes. So that is additional cost that might have to be incurred. And of course, in terms on the recessionary concerns, there could be cut in corporate budgets, which will affect the corporate travelers, which are typically the higher yielding ones who spend more. So folks, with this, from these numbers we read through to SIA results that will be coming out on the Tuesday evening, it seems to show that there's not much to be expected from the engineering business. From 66 million in FY23 to return back to the pre-pandemic level of 160 to 180 million net profit, that could take them another year or so. That's all I have for today. Maybe we can move on to Q&A.
Yeah, thanks, Maggie. I think I'll take the 2 questions regarding the banks first.
Okay, thank you.
Yeah. Okay. So the first question is asking, what is credit cost for banks? Credit cost is basically the provisions over their loans. So provisions is what they set aside for their sort of for loss. So they are associated with the risk of lending their money out. So this is just a very rough overview of what credit cost. I mean, I'm pretty sure it's much more detailed than that. But in the layman's terms, yeah. So this is the risk. So the higher the credit cost, it's not as good. So during COVID times, actually the credit costs were all double digits and higher. And lower it is, the better. At least it's less risk for the banks. So what we are seeing now in this environment is that the credit cost, while of course there are fears of recession and high interest rates, the credit costs have still remained low for the banks, and they're also guiding for it to be low. So we have seen it return to even below pre-pandemic levels. And what their banks are guiding for is also for it to maintain at these levels. And I think we will sort of see these levels for the rest of the year at least. I think if you want to know what the actual credit cost figure is for the banks, for DBS, it's currently at 6 basis points. OCBC, it's at 12 basis points. And UOB, it's at 25 basis points. And this is all for first quarter. Okay, I hope I answered that question on credit costs. Yeah, second question. Sorry, couldn't come on earlier, miss your analysis on the banks. Yeah, no worries. This webinar will be uploaded on YouTube, so you can be sure if you really want to watch me, watch my face and hear me speak, you can watch it on YouTube as well. It'll be uploaded soon, I think by today or by tomorrow, latest by tomorrow. So the question is, the Singapore banks have come down quite significantly, and DBS seems to be particularly hit, perhaps by the outage issue and the higher CR imposed on it. So, okay, I'll answer this question first. Yep, you are right. So it is also, I mean, they had two big technical, or I would say IT related, technology related issues in the past year. And I guess MAS has come down harder on them this year, on this time. I mean, and so because I think it's within 6 months, they had another issue again. So yeah, that might be one of the reasons why DBS seems to be hit harder than the other banks. But the main reason for why the banks are not doing as well, at least their share price is not doing as well as it would seem from their results. You know, their earnings are all reporting record levels of profits. You know, net interest income is growing. So it might be the reason. It might be several reasons. The first reason is that the net interest margins have not yet stabilized, and we are not really seen how the higher funding costs will affect them. So that might be what the market is sort of expecting, and they're just, you know, a bit hesitant for now. And the other key point would be their CASA. So the CASA is their current account savings accounts ratio. So this is very important for the banks. The higher the ratio, the better it is for them, and the lower it is, it's not as good. So why is this so? The CASA ratio is basically the bank's lowest cost of funds. This is the accounts that you get on your like multiplier, one account, or the 360 account for the local banks. So these are the lowest cost of funds for the banks. You know, I think it's less than 1%, if I'm not wrong, for the base amount compared to a fixed deposit, which is giving, you know, north of 3.5% now. So if this CASA ratio goes down, it means that their cost of funds increase, as you know, the customers are now putting their money into either pulling it out and putting it somewhere else, or they're putting it into fixed deposits, which is what we're seeing. So their cost of funds are slowly creeping up, and you know, it has not stabilized yet, the decline in CASA at least. So until we see that, we do not really know where their NIMs will end at. And I think the banks are also been steadily sort of lowering their guidance for the NIMs, the net interest margin. And the second point is why the banks' share price has been quite lackluster would be the loans growth. So loans have been stagnant for the past few months, and I think we have seen it, you know, in the first quarter, all banks have not seen a growth in loans. I think even one had a sort of UOB had a decline of 1% in their loans growth. So they all say that they're still very positive, and they are putting more resources into finding other sources of loans growth. But I think until we go into the second quarter, where we can see where we are at for the loans growth portion at least. And okay, what are your target prices for the banks? Yeah, so the target prices have not changed for us. DBS is at $41.60, OCBC is at $14.96, and UOB is at $35.70. So there's no change for our target prices for the banks. How do rate hikes in Europe affect Singapore banks? So I would say the rate hikes in Europe may not affect Singapore banks as much on more of a, if you look straight into their loans, because if, like for Singapore at least, the higher the interest rate is, two things will happen. The banks will earn more, definitely, because majority of the loans are in floating interest rates. So they will, if the interest rates go up, they'll just adjust, your loan pricing. I think everyone has felt it, your housing loan will just go up because of the rise in the interest rates. And so they'll definitely earn more. So that's one thing. But however, there's also it's a double-edged sword. The second part is that with the interest rates going up, loans are more expensive, and the banks may not be able to get as much loans as they did, when the interest rates were extremely low. So you can see in COVID, loans growth was racing at a unseen levels, increasing almost month on month crazily. But now we are starting to see it start to flatten, and this is also partly due to the rise in interest rates. But to your point of how do the rate hikes in Europe affect Singapore banks, I don't think they will really affect Singapore banks as much, because they don't really have majority of the loans excuse me, majority of the loans are not really in Europe. So I don't think they will really see sort of a hit from Europe, at least for the Singapore banks. Maybe on a macro scale, they might see some slowdown. Overall people are being more sort of prudent now, and they might want to just keep cash in fixed deposits, and this will increase their funding costs, as I mentioned earlier. I think not just Europe. If you see the interest rates in the Hong Kong, which is why we included HIBOR now instead of SIBOR, which is the Hong Kong interest rates. When it dipped, it actually affected the bank's names. I think more particularly affected DBS. DBS came out and said that it affected them by 3 to 4 basis points on their names due to the dip in the Hong Kong interest rates. So you can see that there's a definite relation between the interest rates and the bank's names. Okay, hope that answered that question. Hi, okay, there's one more question. Any intention to revise your TP for banks, especially? Sorry, we can't say that we have any intention of no intention of mentioning the revising our TP. So I can't comment on this question. Okay, I think that's all for me. I will now hand it over to the rest of my colleagues. Thanks.
Can I take the first question first, Darren? There's a question.
Yeah, sure. Thanks.
Yeah, because otherwise this participant, if you wait too long. Okay, the question is recent surprise BOE interest rate hike. Please discuss impact on Singapore market in general. Which counters are likely to benefit or suffer? Okay, Paul is not here. He probably can answer this better, but let me try what I have. Okay. First thing first is when interest rates are higher, it will affect the value of the assets, especially those assets that are located in UK. So because when you value an asset, typically you use a discounted cash flow valuation on the cash flow to be received from the asset. So therefore, a higher interest rate will actually lower the value of the assets. So this, in summary, it means it will affect those companies who have UK properties. Like first come to mind, of course, is CDL has a relatively larger UK exposure. Together with CAL Hospitality, also have some hotels there. Darren can correct me later if this is not correct. Okay, then the biggest one that come to mind is of course ComfortDelGro, who is a UK operations in terms of bus services, and they have a indexation clause. I don't recall wrongly, but they don't get revised upwards so quickly as inflation rises. So there is delay in indexation. So in the short term, they will be impacted by a higher interest rate while they still could not raise their bus fare yet. Then the beneficiary I could see is probably Sembcorp Industry. About 7% of its renewable assets are located in UK, and all this have a pass-through mechanism. The cost pass-through mechanism, when inflation is higher, it will get affected into the tariffs. So these are the few that I could think of for the impacts on the Singapore counters. Handing back to Darren. Thanks.
Yeah, thanks, Peggy. Yeah, okay, so there's a question. Has Prime bottomed out? Please comment on Capital Pacific Oak compared to Prime. Yeah, so regarding whether Prime bottom out, that one I definitely would not know. Regarding when to enter and when not to enter, perhaps can ask Zane, but unfortunately Zane is on leave today. So for TA, perhaps can ask next week. Yeah, so for the TA portion, I do not know, but from the fundamental perspective, Prime right now is trading at 0.3 times. So that is really at distress levels already, and 25% dividend yield. So at this point, yeah, if they do not default or if they continue to remain listed, I think perhaps it could be, you can consider some short-term trader, but yeah, that's just my point of view, because it's really so it's really at distress levels. And for the comparison with Capital Pacific Oak to Prime, yeah, so first of all together with Manulife US REIT as well, of course. So right now we all know the headwinds that Manulife US REIT is facing. So to begin with, all three of the US listed commercial property REITs that are listed in Singapore, all of them will, most of the time, they'll trade together. Like if because of the sentiment as well, right? I mean, like you see if the US market, like let's say the commercial space is having this credit tightening issue, like a lot of property in the US are defaulting on the loans as well for all these encumbered loans. Yeah, so all this will affect the sentiment there. And then if we see all this negative news flow affect, it will affect all three of them. So it's kind of they'll trade in line also. It's hard to see, like let's say Prime going down and Capital Pacific or going up in share prices. Yeah, I think that is fairly unlikely. Yeah, and then for Capital Pacific Oaks properties, they are also located around a lot of similar areas to Prime as well. And their gearing is lower than Prime, though. It's at 38%. Yeah. Yeah, we do not cover Capital Pacific Oak. So that's all. Yeah, so that's all I can recall for the comparison. But the sentiment is definitely similar for the three US listed REITs. Especially now that since Manulife is facing this strategic review thing. Yeah, and then that brings me to the next question of, is Manulife financially sound? Price tuned to a mere 14 cents. Yeah, so that is because of the weak leasing momentum as well, and of course their gearing is at 49.5%. Yeah, I can't remember the exact figure. Maybe Mel can correct me if I'm wrong. Yeah, so this gearing, right, at 49.5%, there are a few things they cannot do. They only can raise funds. They only can raise more funds if for refinancing purposes, and they cannot raise funds for other users like capex or acquisitions. So until they lower their gearing for now. So since right now they are at 49.5, yeah, they are quite tight. They can't do a lot of things. Yeah, so which is why they are looking at a strategic the review with the Mirai acquiring a portion of their shares. And the thing to note is that for Manulife, their sponsor is not abandoning them like a lot of people used to think previously, that Manulife they want to sell out their stake. But actually no, Manulife they'll maintain their 9.1 stake, but they're tight because of some internal covenants or some internal the word internal yeah, basically some internal investment mandates. Yeah, that's a term. Yeah, that they are constrained by this 9.8% unit holding limit, and they can't inject more into it. So yeah, because of that, It's not that they want to abandon the REIT. Yeah. Yeah, but definitely we wait for the good news from the Mirai so-called acquisition of a portion of the sponsor. Yeah, and all that is still in discussion. It's still in the negotiation phase, and we do not know the outcome yet. But it's highly likely that Mirai will acquire some portion in Manulife.
Maybe I take over for
Yeah,
next
yeah.
question.
Yeah. Thanks, Peggy.
Okay, thanks. There's a question by Cheryl Yip on questions on PropNext. I'm asking your view of Singapore PropNext shares, property in Singapore. Okay, PropNext have we're still waiting for their first quarter results. But if we just read through from APAC Realty's last Friday's results, seems to suggest that the week is a weak first quarter, then that is probably expected because of the low number of new launches in fourth quarter last year and first quarter of this year, especially after the cooling measures in place from December last year. And then early this year there's another, just recently they had raised the ABSD. Okay, so there's the expectation of a weak numbers for first quarter, but the outlook appear to be very much more positive in terms of number of units coming out on the market. There is probably about another 35 projects with about 12,000 units to be launched from January to end of this year, assuming they don't delay the launches. That compares with 4,000 units for the whole of 2022. And so with more new units launches, they also spur the demand and the transaction volume in the resale market, as there will be disposal of the resale unit to upgrade to the new properties, or even from the HDB upgraders to resale units or to a new property. So it will revitalize the market, will be active. And then also the number of BTOs that are going to be completed is going to be step up. That also generate the volume. The only caveat is whether there will be any cooling measures that might be introduced. That one we can't tell. But the prices seems to continue to hold very well. So there is a risk there, and on top of that, mortgage rates are rising at a very fast rate. So Paul covers PropNext, so I'm just trying to answer whatever little information I have. Maybe when at the next meeting he can elaborate further. He will have a better insights on the PropNext. Okay. I hope I answered that question, though very little I can contribute. The next question is, why Genting Singapore dropped a lot today after they report good results? Thanks. Okay, the results actually came in below the consensus estimate. It's about 17.5% of the Bloomberg consensus. So I think most analysts are probably busy now trying to revise their forecast downwards. And that's because they have we read Marina Bay Sands results. It was a very robust set of numbers. So the market was expectations was hype up. Then this set of Genting numbers kind of disappointed us. The non-gaming revenue actually was weak, and they also said they had a very poor VIP luck factor, which means the VIP take back more than they should on average. So therefore the price dropped because of this disappointing earnings. Okay, it actually on a Q-on-Q basis, revenue was down 10%. Yeah, so that's not something we thought should happen, because we saw tourist arrivals have been picking up. I hope I've answered that question. Jerry, would you like to take the last question?
Yeah. I'll answer this question. Yeah. So just to clarify, I do not mean that prime, yeah, I think I was misunderstood. I do not mean that prime is at distress levels. I mean that they are trading at distress levels. Their operations are still okay. Like right now, they are at 88% occupied, their portfolio. And we think that even though all these movements in and out, like Sodexo probably leaving at the end of the year, we'll still see occupancy above 85%. Yeah, so when I say that distress levels, it's just that their share price is trading at distress levels. Operationally wise, they are fine, they are good. Yeah, so that's what I mean when I said distress levels. Cost 21 cents is just based on valuations is 0.3 times or even lower than 0.3 times price to NAV. The thing move. Yeah, and then because of that, I also cut my target price. Used to be at 70 cents, and 70 cents, bear in mind, is at about 0.9 times price to NAV. So I cut my target price by 35% from 70 cents to 46 cents. Yeah, so that is why I still have it as a buy, because at 21 cents, 0.3 times, and then even my target price right now, 46 cents, it is about 0.6 times price to NAV. Yeah. So that's the reason. What did you say first? Yeah. So for Prime, we understand that there are a lot of headwinds and a negative news flow. So our target price, we have an outlook of 1 year. And it's not to say that we think that in the near term we reach 46 cents. Yeah, our range is 1 year. So yeah, that's why also we think that if you look at a valuation standpoint, it could be a good reason for you to enter as well. And at this point, we think most of the negatives are already priced in. Yeah, I keep emphasizing the 0.3 times price to NAV and 25% dividend yield, but yeah, because operationally wise, they're okay. Yeah, then another question, still buy rating. Yeah, the same thing. Yeah, so right now the credit, the issue is with the credit, right? But Prime, their next refinancing after this extension of the maturity will be July 2024, and by then hopefully everything will be better. Like the interest rates, most likely they already peaked and probably stay flattish for a couple of quarters, and then but probably hopefully next year, by next year the rates will start to go back down. Yeah, then that would be definitely a catalyst for Prime, and hopefully by then by next year things are looking better and Prime will be able to refinance the loan. But yeah, in the near term for Prime, yeah, it's not that negative as what you're saying in the chat. Yeah, I think that's all for me. I don't see any more questions. So if there are no questions, perhaps we could end. Sean, you want to take over?
Yeah.
Or anyone?
Okay, yeah. Thanks, Darren. So I think there's no more questions anymore. And yeah, like I mentioned earlier, because Zane is on leave today, so there will be no technical portion for today. So if you still have any more questions, you can drop it down in our community chat, and we'll see you guys next week. Thank you.